Welcome to class 2 of investment appraisal. In this class we're going to be solving an example. I implore you to watch class 1 if you have not watched it, because it will help you to understand what we're going to be doing in this class. So we're going to be reading this example as you can see on the screen. Japako is considering a project whether or not to commercialize an innovative muscle turning device (MTD) that will be used in treatment of sporting injuries. It is expected that the commercial life of the MTD will be 4 years, after which technological advances will bring more sophisticated devices to the market and the sales of MTD will fall to virtually zero. 8 million has been spent in developing and testing the device over the past year. So once you see that 8 million, you already know that is a sunk cost, because you can spend that money and still not carry on with the project, right? So you know that it's an irrelevant cost. That's why I'm saying you should watch class 1, because I've already explained the breakdown. Let me say something. The way I actually planned for us to understand this investment appraisal was by dividing it into 3 branches. The introduction, the methods of investment appraisal, and like other aspects. Let me stand up. Other aspects, right? So what we did in the first class was that we tried to understand the introduction. Yes, I talked about relevant cash flows. I talked about taxation in investment appraisal. I talked about working capital in investment appraisal. I talked about inflation. That's what I'm saying you should go and watch it, because every of these concepts of basic assumptions is in this question that I'm about to solve. I talked about what else? Capital allowance. That's tax savings on capital allowance. Then the methods. I said there are various methods of evaluating investment. Investment appraisal is about evaluating, appraising an investment opportunity, different alternatives to know if you should accept or decline the project. So we have the methods, we have NPV, we have IRR, internal rate of return, net present value, we have modified internal rate of return. These 3 methods I told you in the first class. I told you in the first class that it looks at the profitability of the investment. Then I said there are other methods. We have payback period. The question we're going to cover all the methods. Discounted payback period. We have project duration, right? Then I said the other aspects of investment appraisal, like other branches, risk and uncertainty. Risk and uncertainty in investment appraisal, APV, adjusted present value, international investment appraisal. These are like subtopics on their own, right? We also have specific investment decisions, and we also have real options and option pricing. You understand? So since we've dealt with this part in the first class, we are now on the methods. So this is what a typical investment appraisal question in SFM would revolve around. You understand? That's why I just had to give this brief introduction. So I'm trying to go and watch class 1. If you've not watched it, that will help you to understand what we'll be doing in class 2. It's just about 29 minutes, right? So let's go back to reading the question as you have on the screen. Initial market research has been conducted at a cost of 2.5 million and is due to be paid shortly. Shortly is like they are going to pay it very soon, before the project commences. So it's also an irrelevant cost. So information on future returns of the investment has been forecast to as follows. So you have year 1 to 4, as you can see. The units in demand, meaning the units they are going to sell. In year 1 you have 20,000. In year 2 you have 70,000. In year 3 you have 125,000, and in year 4 you have 20,000. They said the selling price in current terms, that is how much per unit per MTD device. Selling price in current terms: 2,000 in year 1, 2,200 in year 2, 1,600 in year 3, and 1,500 in year 4. Right? It looks so easy, but this is the twist in this question. They said the selling price is in current price terms. Remember in the first class, right? I told you can have your cash flows in real terms and in money terms, right? In real terms, which is also current terms, is when it does not have inflation. There is no inflation. Then in money terms is when inflation is included, right? So they give you this thing in current terms, no inflation included. That's what it means. So if they are giving you a price of 2, they are telling you that in 1 year time is actually going to be inflated at this amount. You see as we read on. They say variable cost in current price terms, 900 in year 1, 1000 in year 2, year 3, year 4, on and on. Fixed cost, 10 million, 10 million, 10 million, like that. Then they said selling price inflation and fixed cost inflation are expected to be 5% per year, and variable cost inflation is expected to be 4% per year. You see that? Fixed costs represent incremental fixed production overhead, which are wholly attributable to the project. It means the fixed cost is relevant. In some cases, the fixed costs might not be relevant. They'll tell you that these fixed costs are incurable irrespective of the decision, or they'll put it in a way that will make you to know that it's not a relevant cash flow. So one important thing in investment appraisal is that you must know your relevant cash flows and your irrelevant cash flows, right? The production equipment for the new device will cost 120 million, would cost, future cost, relevant, 120 million, and additional investment of 20 million will be needed for working capital. We also talked about working capital in the first class. Go and watch it so that you can understand the assumptions of working capital, right? The equipment is expected to be sold at the end of 4 years for 10 million, that's disposal. So most investment appraisal questions will have a lifespan. This one is 4 years, and at the end of 4 years, they say they will sell it off at 10 million. That's the residual, the scrap value, right? So when the production, 10 million, when the production and sales will cease, the average general level of inflation is expected to be 3% per year, and the working capital would experience inflation of this level. Capital allowance, which is tax allowable depreciation on a 25% reducing balance basis, could be claimed on the cost of the equipment. Profit tax of 30% per year will be payable 1 year in arrears. A balancing allowance will be claimed in the 4th year of operation. Jakpako has a real cost of capital of 7.8%. What you use to discount the cost of capital is what? 7.8%. So it's upon this cost of capital that you apply the general inflation, right? Because they gave you real cost of capital and they gave you real cash flows. And those real cash flows, because you would inflate them, they said there are some specific inflations of 5%, 4%. Because you're going to inflate those cash flows, this cost of capital will become irrelevant because it is still in real. So you also need to inflate the cost of capital by the general inflation. That's where you bring in the Fisher's formula, which I explained in the first class, right? That 1 plus money cost of capital equals to 1 plus real cost of capital plus 1 plus inflation rate. Okay, you can watch that video. I did an example to explain that very well. Then it said required, calculate A, the net present value, B, the internal rate of return, C, the modified internal rate of return, D, the project payback period, E, the discounted payback period, F, the project duration. So this question just covers everything. Okay, so let's start from the net present value. That what they said you should calculate. So we've understood the question, right? In a typical ICAN question, you are advised to start reading the requirements first. When you read the requirements, it helps you to know what to look out for in the question. You know if you can solve it or not, so you don't waste time, because time is a limiting factor. So you start from question A, which said you should calculate the net present value. What do you need to do? Write the name of the company, right? Japa Limited or Japako. This is how to answer it. Evaluation of investments in MTD, the money muscle turning device, through net present value. Okay, so that's your heading. Then the first thing to ask yourself is how many years are in this investment? What is the lifespan? It is what? 4 years, right? So you have your year 1, year 2, year 3, year 4, and it will extend to year 5. Why is it extending to year 5? Because you were informed that tax is paid 1 year in arrears, meaning that tax of year 1 is applicable in year 2, tax of year 2 is applicable in year 3, tax of year 3 is applicable in year 4, and tax of year 4 is applicable in year 5, and that's why it spreads to year 5. And don't forget to add your year 0. Year 0 means today. Like your initial investment is assumed that you are incurring it today, right? So that's what will fall under year 0. Year 0 means that time value of money is not affecting it. That's just what it means. So the first thing to start from in this question is to start from your sales, right? Your sales. Now somebody might be thinking, is there a format to calculate your net present value? There are formats, but it depends on the variables that you are given. In some questions you might not have to calculate sales. They might have already gotten the net cash flows. All you need to do is to discount and know whether you should go on with the project or not, right? So what you just need to know is that you are trying to get net present value, and that net present value is a particular amount, either positive or negative, that will help you to decide whether you accept the investment or reject the investment. And to get your net present value, you need to get what? Your present values, right? Your present value of year 1, year 2, year 3, year 4, year 5, if possible, like that, right? And to get your present value, you need to have what? You need to have discounted. So you can see the format. You discount at certain percentages, right? And to discount, what are you discounting? You are discounting your cash flows, right? Your net cash flows, okay? Your net cash flows, that's what you are discounting. And how do you get net cash flows? Is by saying inflow minus outflows, right? So what is the outflow? Those are the questions you need to ask yourself. The outflow is what? The initial investment, the working capital. Initial investment, working capital, those are your outflows. They can even say, just like told us this question, that there will be disposal. That's an inflow. In the last year, they will receive 10 million when they dispose the device, okay? So those are your outflows, right? Then you've gotten your outflows. So what are your inflows? Your inflows are the sales, right? Net inflows, sales minus cost, right? So that's why we are working from sales. I don't know if that makes sense. So really, there's no format, but if you can know that this is what you're trying to get, and to get this, you need this, you need this, that will kind of construct the format in your head. Because I know somebody can be confused and just go and start from solving working capital first, right? So your sales, now you need to go to your workings. You have workings 1. So you flip to the next page. I'm not going to be doing workings, just be writing it somewhere in your note. Workings 1, okay? They told you in this question that in year 1 they will sell 20,000 units. At how much? That's 2,000 naira in real terms. Today's term is at 2,000 naira, but they said the price will inflate by 5%, okay? So in year 1 it will be what? 2,000 naira times 1.05. Year 1 price is 2,000 naira per device times 1.05. You need to inflate, right? It's like you're saying times 100% plus 5%. That's what this 1.05 means, okay? So 2,100 times, how many are they selling? They are selling 20,000 units. That's 42 million, okay? So in your year 1 they will sell 42 million, okay? So let's just abbreviate. Let's put the remaining naira up there. So you have 000. You know, you are abbreviating the digits so that you can save time and minimize space. In year 2, they told you that the price in real terms is what? 2,200. You what? Inflate. That's 2,200 times 1.05. That 1.05 will be raised to power 2 because it's year 2. Do you understand? This year 1 was price of what? 2,000, right? Times 1.05 raised to power 1. This one now, year 2, you said the real price terms is 22, right? Times 1.05 raised to power 2. Okay, so that's what you're doing. For year 3, it will be raised to power 3. Year 4, the number of year, okay? So that's how to inflate it. Sorry. So you have 1.05 raised to power 2 times 2,200, and that gives you 2,425. The price, just multiply immediately by the number of units, 70,000 units, and that gives you 169,785,000. Okay, then in year 3, 1.05 raised to power 3 times real price terms of 16 times 125,000 units. That gives you 231,525,000 naira. This is a trick to waste your time in the exam, so you have to be very fast. Like 1.05 raised to power 4 times 15 times 20,000 units, 36,465,000. Yeah. So year 5 now, there's no sales. It's just here. It's because of tax that we extended to year 5. After your sales, what is it? Costs. First one is your variable cost, right? Take that one to workings 2. Okay. So in your variable cost, they said that it is inflated by 4%. 4%. So these prices that you are given, that 900, 1,000, 1020 naira, 1020 naira, you inflate by 4% and you multiply by the number of units because it is cost per unit. Does that make sense? So in year 1 we have 900 times 1.04 times 20,000 units. We have 18,720,000. This is an outflow, so you put it in brackets. Does that make sense? In year 2 we have 1.04 raised to power 2 times 1,000 times how many units? 70,000 units. That's 75,712,000 outflow, right? In year 3, let me show you guys how I'm calculating this thing. You don't have to write in those thousands because of time, right? So you have year 3 1.04 raised to power 3 times, what's the price? The price is 1,020 naira times how many thousand units? 125. Just write 125. So you have 143,420. That's 143,420,000 160. Does that make sense? So that this abbreviation has cancelled out that one. Then for the last year you have 1,020. So that's 1.04 raised to power 4 year 4 times 1020 times 20,000 units. So that would be 23,865,000, right? Then in your next cost is your fixed cost, and that is in workings 3. They said that one it is inflated at what? 5%. Okay, 5%. So that one is 10 million, 10 million, 10 million, 10 million, right? That's 10 million times 1.05. that will give you 10,500,000. 10,500,000. For year 2, 11,025. For year 3, 11,576. For year 4, 12,155. Right? And that's all for your costs. After you do all of this, you have what? Cash profit before tax. Right? Cash profit before tax. Why it's meant to be profit before tax normally, but it's cash because everything is in cash. You know, anything that is non-cash is irrelevant, so we didn't include it. Now you must put cash profit before tax. So you cast this. So after you cast this and you get your cash profit before tax, which are these figures, the next thing for you to deduct will be your tax, right? You must apply tax on your profit, and tax will be what? 30% of cash profit before tax. See what the question says. The question says that, let's read that together. The question says profit tax of 30% per year will be payable 1 year in arrears. So tax of year 1 will be applicable in year 2, like that. So in year 1 you have 0.3, which is 30%, times 12,780. That will give you 3,834,000. Okay, so you apply it in year 2, 3,834. Then for year 2 tax, you apply it in year 3, 0.3 times 75048. That will give you 22,514. Now year 3 tax, 0.3 times 76,529. That will give you 22,959. Okay. Now year 4 tax, which is the reason for the creation of year 5 column, 0.3 times 445,000. That will give you 134. So after your tax outflow, you now have your tax inflow, which is what? Tax savings. Okay, and tax savings will be what? Your tax rate, 30% of capital allowance, right? So you go to your workings, you flip your page to your working notes, okay, where you're trying to calculate, maybe working 3 or whatever. Okay, working 4, you're trying to calculate your capital allowance, right? So based on what the question said, they said capital allowance means depreciation. Okay, is 25%, as in capital allowance is 25% reducing balance basis. That could be claimed on the cost of the equipment. Okay, so your capital allowance is 25% reducing balance. So what you need to do is that for year 1, what is my capital allowance? When you get your capital allowance for year 1, you apply the tax rate on it to get your tax savings. I explained the reason why there is tax savings in class 1. So if you have not watched class 1, it's not my fault, right? But I'll still try and give some explanations here. So in year 1, your capital allowance will be what? 25% of 120 million, which is the cost of the assets, right? In year 2, it will be 25% on what? Reducing balance. That is 120 million minus, let's do that, 25% of 120 million, that's 0.25 times 120, that's 30 million, right? So in year 1, our capital allowance is 30 million. The balance left, the reducing balance, will be what? 90 million. After you've deducted this 30 from 120, the reducing balance that will be left to be 90 million, right? So that's where you apply the year 2 capital allowance rate on. Okay, so that would be 0.25 times 90. That would be 22.5 million, right? Let's be writing it in full. It's abbreviated into 000. So for year 3, your capital allowance will be 25% of what? At that point, it will be 120 million. 120 minus 30 minus 22.5. You know the reducing balance now. That's 67.5 times 25%. That's whatever the balance is. Just write it's reducing balance. So it does 16,875,000. Okay. Then in year 4, your capital allowance. Year 4 being the disposal year. Hold on the capital allowance, because why? They said they dispose the assets. In the year whereby they disposed an asset, you're not going to charge capital allowance. No, capital allowance is charged at the end of the year, after the whole year's activities has ended. In the assumption, with the assumption that you are preparing the financial report now. But in a cessation year, you are closing the business, so they are selling off the assets. So there's no need to calculate the capital allowance. Just keep your balance aside. That is, what is the value of that asset at the end of year 4, right? Is what? 120 million minus 30 minus 22.5 minus 16.875, right? That's 50,625,000. Okay, so this was the asset value, the reduced balance. Then they said in the question that it will be disposed at the end of 4 years for 10 million. So something worth 50,625,000 being disposed at 10 million. It means there's a loss, right? They made a loss of 40,625,000. So that loss is called balancing allowance. So you guys know this one. I explained everything in the first class. Balancing allowance, right? So instead of you calling this capital allowance, you call it what? 40,625,000 balancing allowance, because it is the disposal year. Does that make sense? Yes, it does. So since we've gotten their capital allowances for each year, you are now trying to get tax savings, you know, because capital allowance, right, is an allowable deduction. So it's like a cost, like relieving you of your asset, you know, for incurring heavily in an asset. So it should have been deducted here. If you had deducted it here, it will reduce your what? It will reduce the profits that will be accessible to tax. So I've reduced this profit that we apply tax on, right? So instead of you deducting it here, deducting this capital allowance here, just calculate the tax savings. Does that make sense? Check the previous class. I explained it in that previous class. So to now get your tax savings, that is this 30,000 naira, this 30 million naira would have been an allowable deduction here. It would have naturally cost tax to reduce, right? You know, this tax savings is a form of an inflow. Okay, that's what you're trying to do. So 30% of this will give you 9 million. Let's just be writing it here instead of us writing it here, right? So 0.3 times 30 million, right? So that's 9 million in year 1. It's not a deduction, no. It's an inflow. It's an inflow. It's a tax savings, right? So it means that the effective tax is a reduced tax. Okay. Then in year 2, 30%, we've done this, 30% of 22.5, that's 0.3 times 22.5 million. That's 6750. Year 3, I hope you guys are punching your calculator too as I am doing it. It makes you fast when you are rehearsing. So in exam, you'll be faster. So 0.3 times for year 3, 16.875. That gives you 5063. Then for year 4, 0.3 times 4625. That gives you 12188. Does that make sense? So once you apply your tax, right? Once you apply your tax, the next thing you have is your cash profit after tax. We have profit before tax. When you apply tax, it's profit after tax you have, right? So you cast all these figures. So now you have your cash profit after tax, right? So this is your cash profit after tax. It's like your inflows, right? You know, you got a major inflow, which is the sales. After you've less expenses and possible incomes, you now have your net inflows. That's what your cash profit after tax stands for. Ask yourself, what are your outflows, right? So your outflow is your initial investment, and besides in the question, right, that the production equipment of the new device will cost 120 million. Okay, so you write that there, 120 million in year 0, because the assumption in investment appraisal is that the initial investment is incurred today. So today is what year 0 represents, meaning that time value of money will have no effect on it. You know, in year 0, when you are discounting year 0, is always 1. That is your discounting factor. You see that when we are discounting, right? Your next outflow is your working capital. What's working capital? I explained it in the previous class, right? Working capital. So you put that in your workings. You go to your workings to solve your working capital. They said here that an additional initial investment of 20 million will be needed for working capital, right? So working capital, you have year 1, year 2, year 3, year 4, extend it to year 5 because of the assumption, and year 0, right? So when they introduce working capital, they introduce it in year 0. That is at the beginning of year 1 means year 0. Okay, so they introduce it in 20 million. The average general inflation is expected to be 3% per year, and working capital will experience inflation at this level. Does that make sense? It will experience inflation at this level. So it means that by year 1, the working capital would have inflated to 3% extra, right? Let's calculate that. So by year 1, your working capital is going to be 20 million times 1.03. That will give you 20,600,000. 20,600,000 in year 1. In year 2, times 1.03 again, that will give you 21,218, right? By year 3, times 1.03, that's 21,855. By year 4, 21 points. By year 4 times 1.03, 22,510. You see that this 22,510 will not be relevant. So I explained in the previous class that with working capital, what you are looking for is the movement, right? The movement, because the assumption is that working capital is introduced at the beginning of the year and is recouped at the end of the year, right? So since you have gotten what you need, you don't just take those figures like that though. It's the movement that is relevant. What you are introducing and what you are recouping is not relevant in this schedule. Is the movement. So in year 1, you are introducing 20 million naira as your working capital. You will recoup it at the end of year 1. The assumption is that when you sell, you get your working capital. You know, your working capital are short-term funds that you need to run the business. Okay, so if in year 1 you are introducing, that is, you are spending, introducing, you are spending what, 20,000 naira. I've closed all of this, so I just use that one to calculate. They are all closed, so this is the format now. At the end of year 1, you recoup it back. Year 2 working capital will be introduced in year 1. Year 1 means the beginning of year 2. Okay, so that's 20,600 introduced, recouped at the end of year 2. You put it under year 2. The next one will be introduced in year 3, the beginning of year 3. That will fall under year 2. 21,218, and recouped by the end of year 3. 21,218, recouped 21,218. It was introduced here. Then for year 4, you are introducing 21,855 and recouping at the end of year 4 21,855. Does that make sense? So you now cast. Okay, so when you cast, that's how you get your movement in working capital. That's the relevant cash flows. I hope this place is showing. So these are the introduced and this is recouped. If you watch the first class, you understand it better, right? So you add, this one is just going to be 20 million. As you can see, that's what you move here. So your working capital, 20 million, right? Working capital. So 20 million minus 20 million, 600 plus 20 million. That will give you what? 600 negative. That's what will be here. 600 negative. Okay? Minus 21, 218 plus 2600. That's minus 618. That's what you have here. 618 negative. Does that make sense? Then minus 21,855 minus 21,855 plus 21,218. Here you have 637 negative. 637 negative. Does that make sense? And here you add, you have 21,855. 21,855. You can even know if you are right or wrong. When you add all of this, you should get a negative equivalent to this, right? So that's the assumption. The assumption is that it's only the movement that you recognize, and it makes sense. When you introduce 20 million in the beginning of a year, and they are saying that by the end of the year you recoup it, then the next year you now need 20 million 600. Since you already have 20 million 600, it's only 600 effectively that you spent. That's the relevant cash flow, right? So after you've introduced a working capital, they said that at the end of the year they would dispose this device at 10 million. So you write your disposal value. Sorry, my marker is fading out. Disposal value, right? Disposal at how much? 10 million at year 4. So you write that 10 million naira, right? They have nothing here, nothing. Then you cast to get your what? Net cash flows. Inflows minus outflows will give you your net cash flow. Ignore the noise, sorry. Then the net cash flows is what you discount, okay? So you have your net cash flows when you cast all of this. So let's solve that. So after you get your net cash flows, which you have already gotten, the next thing you need to do is to discount. Discount at how many percent? Now they told you here, you always discount at the cost of capital that is given. But what if you are asked to determine cost of capital? That's why we've done a class on cost of capital, right? They might give you some information that you would want to compute the cost of capital at which you used to discount. And that is the case here, actually. They said that Japa Limited has a real cost of capital of 7.8%, right? They gave you the real cost of capital as 7.8%. But can you use real cost of capital to discount money cash flows? No, you should only use real cost of capital to discount real cash flows. Okay, so you need to convert this real cost of capital to money cost of capital. And how do you convert to money cost of capital? Is by bringing in inflation through the Fisher's formula, which we did in class 1, right? So that's 1 plus M equals 1 plus R plus 1 plus I, right? So 1 plus M equals 1 plus R. 7.8% plus 1 plus inflation rate 3%, and that will give you 11%, right? I believe you know how to punch this in your calculator. So your discounting factor or discount factor is at 11%. So we start to discount. Now what are the factors? For year 0, you know that though, it will be 1.000. For year 1, you know how to get discount factor. 1.11 raised to power minus 1. 0.901. For year 2, it will be raised to power minus 2. 0.812 raised to power minus 3. 0.731 raised to power minus 4. 0.689 raised to power minus 5. 0.593. Right? Now, when you have your discounting factors, you discount it. What does discounting mean? It means you are trying to get the present value. Tell me what it is today. Let me understand today's language. Don't promise me that after year 5 I'll get 12 million. Discount it to today's value. Let me know what it is. By the time we discount, the value will reduce, so you can make a decision based on what you understand today. Right? That's the concept. So you have your present values, that is today's value. Here you have 0.901 times 12,180,000. You have 10,974. 0.812 times 79,596,000. We have 64,632. 0.731 times 60,128,000. We have 43,954,000. 0.689 times 14,404,000. That will give you 9,924,000. Okay, then 0.593 times 12,054. That will give you 7,148,000. When you have the present values, all the present values, you will now cast, you add all of them together to get your net present value. Right? So let's do that. This plus this plus this plus this plus this minus this 140 million. So that gives you a positive NPV of 3,1. Sorry. That gives you a positive NPV of 3,124, right? So that's 3,124,000. Okay, your answers don't have to be exactly like this, but it will be something close. You know, you're just estimating. It's an estimation. Even because of all these are discount factors, because of these abbreviations, your answer might not be correct. But the important thing is the decision, right? So this JAPA Limited, they should actually accept this project because it has a positive NPV, right? Because it has a positive NPV of 3,124,000. So the next part of the question says calculate the internal rate of return. So we're going to do that in the next class, the internal rate of return. So watch out for the next class. In fact, you can click it right now and go to the next class.